Retirement is supposed to be your golden era. You have worked incredibly hard for decades, saved diligently, and now you simply want to enjoy your peace and quiet. The absolute last thing you want to see when you open your mailbox is a thick, terrifying envelope from the Internal Revenue Service. But here is something important to understand right away. When most of us think of the IRS, we tend to picture stern agents in dark suits holding briefcases, looking to harass honest seniors. That image does not reflect today's reality. Today, the IRS is not really a group of people at all. Instead, it is a giant, highly advanced computer system. It relies heavily on automated algorithms that quietly scan millions of financial transactions, tax returns, and bank records every single day, looking for anything that breaks their programmed rules. And this is where the real problem starts for so many retirees. Because of updated, incredibly strict financial tracking laws, the entire banking landscape has changed under our feet. Innocent, everyday banking habits are now getting caught in this massive digital net. The same things our parents did without a second thought, whether shifting cash around just to feel a little more secure, or stepping into a local bank branch to help out a grandchild with college expenses. These moves feel completely normal to us. But to the automated IRS computer systems, these actions are suddenly triggering massive, automatic red flags. It creates a frustrating situation where doing something generous or private accidentally puts a target on your back. You should never have to feel anxious about managing your own hard-earned money, and you definitely should not have to guess what the rules are. What follows is a thorough walkthrough of exactly how 7 everyday banking moves look to the IRS, why they accidentally cause trouble, and the simple, stress-free ways you can handle your money instead. Picture this relatable scenario. Let us say you have a friend named Bob. Bob has been saving his money, and he finally finds the perfect used RV to take his grandkids camping. The private seller wants $12,000, and Bob wants to pay in physical cash to negotiate a better deal. Now, Bob remembers hearing that if you take out $10,000 or more at one time, the bank is legally required to file a report with the government. Bob is a completely honest man, but he values his privacy. He does not want the IRS tracking his RV purchase. So, Bob comes up with a plan. On Tuesday afternoon, he goes to his local bank branch and withdraws $6,000. Then, on Thursday morning, he goes back and withdraws the remaining $6,000. He walks away thinking he has smartly avoided the government paperwork. Here is the harsh reality of what just happened. Under a strict federal law known as the Bank Secrecy Act, financial institutions must file a currency transaction report for any cash movement over $10,000. But the IRS and banking regulators know people try to bypass this rule. What Bob just did has a formal name. It is called structuring, and under 31 U.S.C. 5324, it is a federal crime, even when the money itself comes from completely legitimate sources. Modern bank software is incredibly sophisticated. The computers are specifically programmed to detect these patterned withdrawals automatically. When the system sees someone taking out cash in smaller chunks over a few days just to stay under that $10,000 threshold, it automatically generates a suspicious activity report. Here is why this matters so much for your peace of mind. A routine currency transaction report for taking out $12,000 is completely harmless. However, a suspicious activity report immediately flags your account for potential money laundering or tax evasion. Because Bob simply wanted a little financial privacy, he accidentally triggered a security system designed to catch major criminals. This simple mistake can lead to the bank suddenly freezing his checking account while their security team investigates. Worse yet, it could trigger a highly stressful IRS audit down the line. Imagine the sheer panic of having your retirement funds locked up all because you tried to avoid a basic banking form. Here is the simple action step. Just be straightforward. If you need $12,000 for an RV, to help your children, or to fix your roof, just go to the teller and withdraw the full $12,000 at once. The bank will file the standard currency transaction report, and that is perfectly acceptable. For an honest retiree spending their own savings, that report is completely routine and harmless. Sneaking around the rules is what actually raises the red flag. Take the money out directly, be transparent, and enjoy your retirement without any IRS headaches. Picture this. You are getting a bit older and naturally starting to think about the what-ifs in life. What if you slip and fall? What if you end up in the hospital and cannot write checks for a few weeks? You want to make sure your daughter can easily step in and pay your utility bills, property taxes, and mortgage without any hassle. So, you go down to your local bank branch and simply add your daughter's name as a joint owner on your checking and savings accounts. It sounds like the responsible, practical thing to do, right? Unfortunately, this incredibly common move creates a massive financial blind spot. When you add your adult child to your bank account, you are not just giving them a temporary pass to write checks. Under the law, you are legally declaring that the money inside that account is now theirs too. You have given them equal, unrestricted ownership of your life savings. And this is where the IRS and legal realities become incredibly dangerous for your retirement. If your adult child owes back taxes to the government, the IRS does not care that you were the one who originally earned and deposited the money. Because your child's name is legally attached to that account, the IRS can execute a levy and completely seize the funds directly from your bank account to pay off their tax debt. Just imagine waking up to find your retirement safety net wiped out because of a tax mistake your child made years ago. But the danger does not stop with the IRS. If your son or daughter goes through a messy divorce, files for bankruptcy, or gets sued after a serious car accident, your retirement money is legally considered their personal asset. It becomes totally vulnerable to their creditors and aggressive lawyers. Furthermore, if your child decides to withdraw a large sum of money from that joint account to buy a house or pay off their own credit cards, it can accidentally trigger complicated IRS gift tax reporting requirements, drawing even more unnecessary federal scrutiny. You absolutely do not need to risk your life savings just to get some help paying your bills. There are completely safe, stress-free alternatives that keep your money entirely in your name and completely protected. First, if your goal is simply to make sure your children inherit your money easily without going through a long, expensive probate court process, you need to ask your bank for a payable on death or transfer on death designation. This incredibly simple piece of paperwork keeps the money 100% yours while you are alive, but automatically passes it directly to your chosen beneficiaries the moment you pass away. Second, if your goal is to have someone help you pay your bills while you are still alive, you should get a financial power of attorney. This is a basic legal document that gives your child the authority to manage your money and sign checks on your behalf without ever making them a legal owner of your assets. Keep your accounts strictly in your own name. Protect your hard-earned retirement and sleep peacefully, knowing your money is completely safe. Picture this. You are cleaning out your attic or a safe deposit box, and you stumble across a stack of old paper Series EE savings bonds. Maybe you bought them back in the 1980s or 1990s, or perhaps your parents bought them for you as gifts. Now you are thinking about doing a kitchen remodel, or maybe paying for a grandchild's upcoming wedding. So you take that whole stack of bonds down to the bank and confidently cash them all in at once. It feels like you just found free money, right? But to the IRS, you just created a significant tax problem. Those savings bonds have been quietly sitting there earning interest for 30 years. Because you never reported that interest along the way, the IRS considers all of it to be income. The very moment the bank teller cashes those bonds, every single penny of that 30 years' worth of accumulated interest becomes fully taxable income in this exact calendar year. Here is why this is so dangerous for your retirement plan. Cashing those bonds creates a sudden, massive, artificial spike in your income on paper, and that spike triggers a terrible domino effect. First, it can suddenly push up the percentage of your Social Security benefits that are subject to federal taxes. Suddenly, money you thought was safe is being taxed at a much higher rate. But the second headache is even worse, and most seniors do not see it coming. That massive spike in your paper income can easily trigger something called IRMAA, the Income-Related Monthly Adjustment Amount. When the automated IRS computers see your income jump above certain thresholds, they notify the Social Security Administration. And because the government looks at your tax returns from 2 years prior, that single trip to the bank today will secretly cause your Medicare Part B and Part D monthly premiums to skyrocket 2 years from now. You could easily end up paying thousands of dollars more in Medicare surcharges simply because you cashed those old bonds all on the same afternoon. Here is the action step to help you avoid this costly mistake. Do not cash out decades of savings bonds all at once. Instead, talk to your tax professional and carefully stagger those bond redemptions over 2 or 3 different tax years. By cashing a few this December and then waiting until January to cash a few more, you can split that interest across multiple tax years. This strategy keeps your overall income bracket lower, protects your Social Security benefits from heavier taxes, and ensures your Medicare premiums stay exactly where they belong. It is a simple shift in timing, but it can save you an absolute fortune in unnecessary taxes and penalties. Picture this very common scenario. You want to help your wonderful grandson put a down payment on his very first house. So, you confidently go to your bank and wire him $40,000 straight from your savings account. It is your hard-earned money, right? You should be able to give it to your own family without the government stepping in. While that sounds perfectly logical, here is the IRS reality for 2026. The federal government has very specific rules about how much money you can simply hand over to someone else. For 2026, the annual gift tax exclusion limit is exactly $19,000 per recipient. If you are married, you and your spouse can combine that for a total of $38,000 per recipient. So, what happens when you wire that $40,000 to your grandson? The bank will process the wire transfer without blinking an eye. However, because that amount exceeds the $19,000 per person limit, the legal burden suddenly shifts completely onto your shoulders. You are now legally required to file a specific piece of paperwork with the government called IRS Form 709, which is the United States Gift and Generation Skipping Transfer Tax Return. Now let us debunk the single biggest myth about this rule. This is where most seniors panic, but take a deep breath. Filing that form absolutely does not mean you owe a massive tax bill. The federal government also has a lifetime gift tax exemption. For 2026, that lifetime limit sits at $15 million per person, a figure made permanent under the One Big Beautiful Bill Act. This means you will not actually owe a single penny in out-of-pocket gift taxes until you give away more than $15 million over the course of your entire life. The only reason the IRS requires you to file the form for your grandson's down payment is so their automated computer system can simply track your lifetime giving. It is an administrative requirement, not a tax bill. But failing to file that form is what triggers audits and messy penalty fees down the line. Here is the best way to handle this. Always talk to your tax preparer when moving big money. But if you want to legally bypass these limits altogether, there is an important strategy to know. If you want to help a grandchild, you can pay their college tuition directly to the university, or pay their medical bills directly to the hospital. When you pay the institution directly, it completely bypasses that $19,000 annual limit under the IRS's educational and medical exclusions. It is a completely stress-free way to support your family while staying fully compliant. This one affects so many of us who are simply trying to declutter our lives. Picture this incredibly common scenario. You are finally cleaning out the garage and the basement. You list an old, solid oak dining set, some vintage tools, and an extra lawnmower on a resale platform. Because hardly anyone carries physical cash these days, you let the buyers send you the money through a payment app tied directly to your bank account. It is quick, easy, and convenient. But here is the messy IRS reality you need to understand. The federal government has been going back and forth on the rules for these third-party payment apps, and it has caused a massive amount of confusion. The rule revolves around a tax document called Form 1099-K. For a few years, there was a huge panic because the government tried to lower the reporting limit to just $600. But for 2026, that threshold has been officially revised. The federal threshold is back up to $20,000 and 200 transactions. However, you are not entirely out of the woods yet. While the federal government raised the limit, several individual states still enforce their own strict $600 reporting limits. Furthermore, payment apps are legally allowed to issue you a tax form voluntarily, even if you did not hit the $20,000 mark. Suddenly, the IRS computer gets a form and automatically thinks your innocent weekend yard sale is actually an unreported, profitable retail business. Here is the frustrating part. The IRS algorithm is completely blind to context. When it receives that tax form, it only sees the gross money coming into your account. It does not know that you originally paid $1,000 for that beautiful sofa back in 1995 and only sold it for $200 today. It simply sees $200 of supposed income. But here's the practical action step to keep you completely safe. First, if you sell personal household items for a loss, which is exactly what most of us do, you absolutely do not owe a single penny of tax on that money. If you do receive a Form 1099-K in the mail, do not panic and absolutely do not ignore it. You simply need to hand it to your tax preparer so they can properly report it on your tax return to show a zero taxable profit. Second, start separating your payment apps right now. Keep one app strictly for sending personal money or splitting dinner bills with family and friends. Use a completely different app if you are selling items to strangers. Keeping your family money completely separate from your yard sale money is the easiest way to prevent the IRS from getting confused. It keeps your retirement finances simple, clean, and totally stress-free. This is a hidden trap that catches so many retirees who just want to enjoy a little travel. Picture this very common scenario. Perhaps you are a snowbird. You spend your harsh winters down in Mexico or Costa Rica. To make paying for your local groceries and monthly rent easier, you simply open a small local bank account. Or maybe you inherited a modest bank account in Italy from a distant relative, and you just left the money sitting there because you were not quite sure what to do with it. Because these accounts are small and far away, most seniors completely forget to mention them at tax time. Here is the very strict IRS reality. The federal government has a rule surrounding a document called the FBAR, the Foreign Bank and Financial Accounts Report, filed on FinCEN Form 114. The governing rule is straightforward. If the combined total of all your foreign accounts hits $10,000 at any single point during the calendar year, you are legally required to file this report with the U.S. Department of the Treasury's Financial Crimes Enforcement Network. Notice the word combined. If you have $5,000 in a Mexican bank account and $6,000 in an Italian bank account, you have officially crossed that $10,000 aggregate threshold, and a filing is required. Years ago, people thought offshore money was basically invisible to the IRS. But today, a powerful law called FATCA, the Foreign Account Tax Compliance Act, has completely changed the game. Under FATCA, almost every foreign bank now actively reports the financial data of United States citizens directly to the IRS. The automated IRS computers simply cross-reference what the foreign banks report with your tax return. If you forgot to file your FBAR, the automated system flags you, and the penalties are notoriously harsh. The civil penalty for a non-willful failure, meaning you simply made an honest mistake and did not know the rule, can easily reach $10,000 or more per violation under 31 U.S.C. 5321. For willful violations, the penalty can reach up to 50% of the account balance. Here is the action step to keep your retirement money completely safe. Sit down and look at every single bank account globally that has your name on it. If you suspect you are anywhere near that $10,000 combined mark, you need to bring this up with your CPA immediately. The FBAR is not attached to your standard Form 1040 tax return. It is filed separately and electronically with the Treasury Department through the FinCEN BSA e-filing system, with a deadline of April 15th and an automatic extension to October 15th. By being proactive and communicating with your tax professional, you can enjoy your winters abroad without ever worrying about a massive federal penalty. This one might surprise you because it involves something many seniors think is only for the younger generation. Picture this highly relatable scenario. You have been hearing all this news about Bitcoin or digital currency, and you get a little curious. While looking at your standard PayPal account or regular banking app on your phone, you notice a button offering crypto. Just to see how the whole thing works, you tap the button and buy a tiny $50 fraction of a Bitcoin. You watch it for a few days, get bored, and completely forget about it by the time tax season rolls around. Here is the IRS reality you need to understand. The federal government is treating digital assets as a top-tier enforcement priority right now. In fact, a specific digital asset question sits right on the very front page of your Form 1040 tax return. Under IRS guidance, digital assets are classified as property, and every taxpayer who files a Form 1040 must answer this question, yes or no, whether or not they made a profit. Here is why your tiny experiment matters so much. Even if you did not make a single penny of profit, the simple act of buying, selling, or swapping crypto means you cannot legally check the box that says no. Starting with tax year 2025, cryptocurrency exchanges are now required to issue Form 1099-DA and report your transactions directly to the IRS. If you check no on your tax return, the automated IRS computer sees the mismatch immediately. Checking no when a transaction occurred is a false statement on a federal tax document, and the IRS takes this seriously. Here is the simple action step. It is just a box. Do not try to hide your purchase or brush it off as too insignificant to matter. Simply check yes, report your $50 transaction to your tax preparer, and sleep peacefully. The IRS absolutely does not care about your $50 experiment in terms of the dollar amount. They simply care about full transparency. All of these rules and IRS forms can sound incredibly overwhelming. But the truth is, the banking system has simply become highly digitized over the years, and adapting to this new landscape requires a little bit of education, not fear. You should feel entirely confident using your own hard-earned savings. To manage your money smartly in retirement, you just need to plan ahead. Keep your bank account strictly in your own name and always communicate with your tax professional before making any big financial moves. The rules exist for everyone. Understanding them is the simplest and most powerful way to protect everything you have worked so hard to build.